Okay, you guys, we'll now start chapter 25. We're dealing with capital investment analysis. What do we know there? Well, capital investment would be purchasing something like property, plant, and equipment. I think of it as fixed assets or assets that will depreciate over time. And we also know that a company is going to have a limited amount of resources, right? So they want to invest in the capital investment that's going to earn them the highest rate of return over time. So maybe a company has $100,000 to invest. They want to purchase the piece of equipment or the building that's going to earn them the largest amount of return over time. Now there's really two categories of methods for calculating return over time on capital investments, or evaluating capital investment proposals. First, I mentioned methods not using the present value or not taking time value of money into account, and then methods that use present value or time value of money. Now, time value of money, we've talked about that before, but it just means that $100 received today is worth more than $100 to be received in the future. So the first two methods we're going to look at don't take that into account. We are going to look at one of the two methods, though, that does consider time value of money. So overall, we'll look at average rate of return. We're going to do it first. You can find the formulas there on page 1163 and 1164. We're also going to look at the cash payback method, which you can read about on 1164 and 1165, even through the top of 1166. And then we'll also look at the net present value method, and they go over it on page 1169 and 1170. Internal rate of return is just a variation on a net present value method. We're not going to go through it. Well, let's start with average rate of return method. Okay, average rate of return. Equal to estimated average annual income which you might notice a problem with already. It's just an estimate. So to me, that's one thing that can be annoying with these, or kind of problematic. You're running some fairly precise calculations based on estimates. So they're only as good as your estimate, really. That's probably the toughest part. But you can run these at all different estimates of average annual income. And then in the bottom half, we're going to divide by average investment. But you guys, even, we have to take our best guess, even if it is based on an estimate. Now, this average investment, what they really are saying here is average book value. Or what's the average amount that the equipment or building is on the books at over its useful life. Okay, so let's break this down a little further. Estimated average annual income is calculated by dividing the estimated total income over the useful life we're going to divide that by the useful life in years. It wouldn't have to be in years. Let's just say useful life. Okay, and then the bottom half of our formula, our average investment or average book value. Your book that calls it average investment, it's really average book value, or what they're saying is, what's the average amount that the equipment or building will be on the books at over its useful life. And there you'll take, the easiest way to do it is take initial cost plus residual value or salvage value. And why are we adding those together? Well, the initial cost is the book value on the day the equipment's purchased. The residual value is the book value on the last day of its useful life. If we add those two together and divide by 2, then we'll get the average amount that the equipment's on the books at over its useful life. Might help to remember that book value is equal to initial cost minus accumulated depreciation. And of course, I mistyped depreciation. Let me fix that. There we go. Alright. So in calculating average rate of return, you want to put estimated average annual income in the top. That's calculated by dividing the estimated total income over the useful life by the useful life, usually in years, could be in months though. And then the average investment, which we really mean average book value there, you guys. It's what it cost plus residual value divided by 2. Now I'll show you why that works, but if you say book value on day 1 plus book value on day 1 of its useful life plus the book value on the last day of its useful life and divide by 2, that'll get you the average book value. Could say here average investment or average book value. Okay. So there's the formulas you'll need. So let's go through this one. On page 1183, it says this exercise 25.1, the following data are accumulated by ChemLab Incorporated in evaluating 2 competing capital investment proposals. Okay, they're trying to decide should they buy testing equipment or a vehicle. Okay, I'm just going to make 2 columns out here. Testing equipment and the vehicle. And we want to calculate eventually average rate of return. We'll start though with estimated average annual income. Okay. For the testing equipment, it's going to be equal to estimated total income over the useful life, $18,060, divided by the useful life in years, which is 6 years. There, you guys, for the testing equipment, we come out with $3,010. That's the estimated average annual income that the testing equipment is expected to produce. Now, income meaning, of course, revenue it's expected to generate less expenses that it's expected to incur. Okay, now let's do the same thing for the vehicle. Estimated average annual income there would be the estimated total income over the useful life of $12,000, divided by the useful life in years. There, it's expected to be 8 years. So we get $1,500 for the vehicle. All right, now we want to calculate the estimated average, the average investment or average book value. Okay. Well, here it's as simple as taking initial cost plus residual value and dividing by 2. Well, let me show you why that would work. Let's drop down here for a second. Let's say you have a piece of it, because this, to me, the formula here is a little bit confusing. Let me show you why that works. Okay, so if we drop down here, let's say the cost of some equipment is $5,300, and the residual value is equal to 300. Okay, well, if we want straight line depreciation, expense every year, then we would just say, what, 5,300 minus 300, and then we would divide that by the useful life, which I didn't give you. Let's say the useful life is equal to 5 years. Okay, so we divide that by 5. Okay, now, of course, you can probably see this already, but that comes out to depreciation expense of $1,000 per year, right? You won't have to know this portion for the test. It's something you probably do know already, but anyway, I just want to show you why this formula works. So if we're depreciating this equipment $1,000 each year, the book value at the end of year 1, remember, book value is initial cost minus accumulated depreciation. So if we're depreciating this equipment over 5 years, at the end of year 1, its book value would be equal to 5,300 minus 1,000, or 4,300. Okay, so the book value of the equipment then would be 3,300 at the end of year 2, 2,300 at the end of year 3, 1,300 at the end of year 4, and 300 at the end of year 5. Okay, so that's the book value at the end of each of the 5 years. Okay, if we add all that up, remember we're wanting an average. If we do the sum here, we get 11,500. Now, if we take the 11,500 and divide it by the 5 years, we get an average book value of $2,300. Okay, so you could do it that way. That's the long version. Okay, you don't have to though. You could just say $5,300, the original cost, plus the residual value of $300. Initial cost $5,300 plus residual value of $300. That's what we had in our formula up here. Initial cost plus residual value. And then we're going to divide those two by 2. You guys, I screwed that up, and here's how. I didn't include the book value on day 1. Okay, so you got to start with your, if you want the average book value, we'd have to take the book value on day 1, the end of year 1, end of year 2, end of year 3, 4, and 5. Okay, if we sum all of that, 16,800, and then we'll divide that. If we want the average, we have to divide it by 6. There's 6 points in time here that we took the book value. End of year 5, or end of years 1 through 5, and on day 1. So it equals 16,800 divided by 6. You get 2,800. So you could do it this way. You could take the book value on, sorry for the screw up. You could take the book, I just forgot to include the day 1 book value. Could take the book value on day 1, and at the end of each of the 5 years, add it together and divide by 6. That gets your average book value. Again, that's the long version. I made it even longer by screwing it up. Anyway, here's the short version. You can just take initial cost plus residual value, which would be equal to our 5,300 plus the $300 residual value, divide by 2, and you get 2,800. You get 2,800 either way. So the easiest way is to just say initial cost, or cost plus residual value, and divide by 2. Sorry to take you through this long example and screw it up, but anyway, we ended up getting it right. You got to take book value on day 1, book value at the end of each of the 5 years, add those together, divide by 6. Well, that gives you average book value. But you can also get it just by saying initial cost plus residual value divided by 2. To me, that doesn't usually make much sense, that formula, unless you've seen the long version. So let's do our average. I'm going to clear this out now. Okay, our average investment or average book value then for our 2 pieces of equipment is equal to, what's the initial cost of the testing equipment, or the amount of the investment, they call it $86,000, plus their residual value is 0. Well, you still have to add it in, divide by 2. It won't necessarily be 0 on the test though. 43,000. Okay, for the vehicle, the amount of the investment is 30,000, plus a residual value of 0 divided by 2. You get 15,000. All right, now remember our formula for average rate of return is estimated average annual income divided by average investment or average book value. Well, we have these two calculated now. So all we have to do is divide. If we want average rate of return, then we'll just say our 3,010 on the vehicle divided by 43,000. It's not 0, it's just rounding. I'll show those as a percentage. And then the same thing here. So 1,500 divided by the 15,000. You can already tell which one's going to be better. 10%. Okay, so if you're only picking one of the two, which one are you going to pick for further investment? Based on the average rate of return. I would select the vehicle. Because it's average rate of return is 10%, while the average rate of return for the testing equipment is only 7%. So you want to pick the one that has the highest average rate of return just based on this calculation. What you'd really want to do is look at all three that we're going to look at in this chapter, and if all three of them point in the same direction, you feel pretty good about that investment. Well, what we did, we took the average, the estimated average annual income, it's just the expected income over the useful life, expected income over the asset's useful life, divided by its useful life. Then we took the average investment or average book value, which you can calculate by just taking initial cost plus residual value divided by 2. You're dividing by 2, you guys, because you're taking an average, and there you're adding two numbers together. You could do it the long way like we did, but there you'd have to divide by 6 because you're adding 6 numbers together to get the average. Either way, though, you take your estimated average annual income, you divide it by average investment to get average rate of return. Now you want to pick the one with a higher average rate of return based simply on this calculation. So based on average rate of return, I would select the vehicle because its average rate of return is 10%, while the average rate of return for the testing equipment is only 7%. Okay, you guys, if you have any questions, please be in touch with me. You don't have one of these to turn in for homework, but just practice it for the final. Again, your final is going to be proctored and on paper, so I would just take out a blank sheet of paper and practice these till you're comfortable with them. A little bit closer to test time, I'll tell you exactly which ones to focus on. But for now, just be practicing them all. Thanks a lot.